The shocking truth about crypto whales, how they secretly control your investments. What if I told you that the so-called decentralized world of cryptocurrency, the place where freedom and fairness are supposed to reign supreme, is secretly controlled by a handful of ultra-powerful players? These shadowy figures, known as crypto whales, manipulate the market behind the scenes, bending the blockchain economy to their will. Think the stock market is rigged? Wait until you see what's really happening in crypto. This isn't just about Bitcoin or Ethereum prices going up and down. This is about power, greed, and control, where a few elite players hold the strings and the rest of us are just pawns in their game. Today we're exposing the dark tactics of crypto whales, how they pump, dump, spoof, and crash markets to turn billions in profit, while you, the everyday investor, are left to pick up the pieces. Hi friends, welcome to our channel, where we pull back the curtain on power, money, and influence. If you're ready to dive into the secret world of financial manipulation, hit that subscribe button and turn on notifications. Trust me, this is one story you don't want to miss. Let's get into today's topic: how crypto whales, those holding massive amounts of cryptocurrency, are quietly shaping the blockchain economy and influencing the value of your investments. By the end of this video, you'll not only know their tactics, but also how to spot the signs of their manipulation so you can protect yourself. To fully understand how crypto whales manipulate the market, we first need to talk about who they are and the role they play in the crypto ecosystem. Crypto whales are individuals, institutions, or entities that own substantial amounts of a particular cryptocurrency, often hundreds of thousands or even millions of dollars worth. For example, in the world of Bitcoin, anyone holding 1,000 or more BTC is considered a whale. And in a market as volatile and speculative as crypto, this level of ownership grants them tremendous power. Here's why. The cryptocurrency market is relatively small compared to traditional financial markets. The global market cap for crypto hovers around a few $1 trillion at best, which is minuscule compared to, say, the stock market or the global bond market. This small scale means that even a single large transaction can send ripples, or even tidal waves through the market. And this isn't some fringe phenomenon. Studies show that just 0.01% of Bitcoin holders control roughly 27% of all Bitcoin in circulation. A similar story plays out with Ethereum and other major cryptocurrencies. This level of concentration creates an environment where whales can not only move the market, they can dictate its direction. But how do they do it? And why aren't we talking about this more? Let's break down some of the most common tactics whales use to manipulate the blockchain economy. 1. The pump and dump scheme. The pump and dump scheme is one of the oldest and most effective strategies whales use to manipulate the crypto market, and it works by preying on human psychology, specifically greed and fear. Here's how it plays out. A whale buys a massive amount of a particular cryptocurrency, which causes the price to rise significantly. This sudden price movement triggers a wave of excitement and speculation among retail investors who fear they might miss out on a potentially life-changing investment opportunity. You've probably seen this happen on social media or forums, where people start hyping up a token that's about to moon, or a coin that's guaranteed to explode. But behind the scenes, the whale is orchestrating the entire event. As more and more retail investors rush to buy, the price climbs higher and higher, often far beyond the asset's true value. Then, just as the frenzy reaches its peak, the whale sells off their holdings, dumping massive amounts of the cryptocurrency onto the market. This sudden flood of sell orders crashes the price, leaving small investors scrambling to recover their losses. The whale, meanwhile, walks away with enormous profits, often at the expense of thousands of unsuspecting traders. The anonymity of blockchain transactions makes it nearly impossible to track down the perpetrators, and this tactic continues to be a common way for whales to exploit the system. 2. Spoofing and wash trading. Spoofing and wash trading are two other highly manipulative strategies that whales use to control market sentiment and trading activity. In spoofing, a whale places a large buy or sell order for a cryptocurrency to create the illusion of demand or panic. For example, they might place a huge sell order that suggests the price of Bitcoin is about to crash. Other traders see this massive order and assume it's a signal to sell before prices plummet, creating a domino effect of panic selling. But here's the catch. The whale never actually intends to execute the order. At the last minute, they cancel it, having already manipulated the market to achieve their desired effect. Wash trading is equally deceptive, but operates in a different way. In this tactic, the whale simultaneously buys and sells the same cryptocurrency to themselves, essentially trading with themselves to artificially inflate the trading volume. Higher trading volume makes a cryptocurrency appear more popular and active than it actually is, which can lure in unsuspecting investors who believe they're jumping into a hot market. The truth is, these trades are completely fake, and the whale uses this tactic to create a false narrative around a coin, driving up its value before they inevitably cash out. Together, spoofing and wash trading distort the market, eroding trust and making it incredibly difficult for smaller investors to differentiate between genuine market activity and manipulative behavior. 3. Flash crashes. Flash crashes are a dramatic and often terrifying example of how whales can destabilize the market with a single move. Imagine waking up to find that the price of a major cryptocurrency, like Bitcoin or Ethereum, has suddenly dropped by 30% in a matter of minutes, only to rebound just as quickly. These extreme price swings are often the result of deliberate actions taken by whales. Here's how it works. A whale decides to sell an enormous amount of cryptocurrency all at once, flooding the market with supply. Because the crypto market is relatively thin compared to traditional markets, this sudden influx of sell orders overwhelms the existing demand, causing prices to plummet almost instantly. Retail investors, seeing the rapid drop, panic and start selling off their holdings to cut their losses, which only accelerates the crash. Once the price hits rock bottom, the whale swoops back in and buys up the asset at a deeply discounted price. Not only have they scared smaller investors into selling, but they've also managed to increase their holdings at a bargain. Flash crashes can destabilize the market, shake investor confidence, and leave smaller traders at the mercy of these sudden and unpredictable moves. For the whales, however, it's just another day of profiting off market manipulation. 4. Coordinated whale groups. One of the most alarming developments in recent years is the rise of coordinated whale groups. Tight-knit networks of whales working together to manipulate the market on an even larger scale. These groups often operate in private chat rooms or messaging apps, where they can discuss and execute their strategies without any oversight. Imagine a scenario where multiple whales pool their resources to target a specific cryptocurrency. They might agree to simultaneously buy large amounts of the coin, driving up its price and creating a false sense of demand. Once the price reaches a certain level, they all sell off their holdings at the same time, crashing the market and leaving retail investors to absorb the losses. This kind of coordination amplifies the impact of market manipulation, making it nearly impossible for smaller investors to compete. What makes these groups even more dangerous is the lack of regulation in the crypto space. Unlike traditional financial markets, where insider trading and collusion are heavily monitored and penalized, the crypto market operates in a legal gray area. As a result, these coordinated efforts often go unchecked, allowing whales to dominate the market and dictate its direction with impunity. The existence of these groups challenges the very principles of decentralization and fairness that cryptocurrencies were founded on, and it raises serious questions about the future of the blockchain economy. And it's not just retail investors who are impacted. Crypto exchanges often cater to whales, offering them preferential treatment like lower fees, faster transaction times, and even access to insider information. This creates an uneven playing field where the average investor is always at a disadvantage. Now you might be thinking, okay, so whales are gaming the system, but what does this mean for me? The answer is a lot. For one, these manipulative tactics create extreme volatility in the market, making it nearly impossible for average investors to make informed decisions. Prices can swing dramatically in a matter of hours, and if you're not paying attention, you could lose everything in the blink of an eye. Secondly, this concentration of power undermines the very principles that cryptocurrencies were founded on: decentralization and fairness. When a handful of individuals or institutions can control the market, it starts to feel less like a revolution and more like the same old financial system dressed up in new clothes. So, what can you do to protect yourself from the influence of crypto whales? Start by educating yourself. Learn to recognize the signs of manipulation, like sudden price spikes or unusually high trading volumes. Be cautious of projects that seem too good to be true, and always do your own research before investing. And remember, while the world of crypto offers incredible opportunities, it's not without risks. By staying informed and vigilant, you can navigate this complex market with confidence and avoid becoming a pawn in someone else's game. If you found this investigation insightful, don't forget to hit the like button, subscribe to our channel, and turn on notifications. We're committed to bringing you the truth behind the headlines, and we've got more deep dives like this coming soon. Thanks for watching, and we'll see you in the next video.